So my name's Theo Andrew. I'm news editor at ETF Stream. With me, I have Elroy Dimson, professor of finance at Cambridge Judge Business School, among many other accolades. And you just published some new research on the equity bond premium. Perhaps you could kind of run us through the key talking points from your perspective from that.
Oh, absolutely. The work that we've done is still not in print, and so this is the first airing that it got, and it was very exciting to share work that I've dealt with several academic colleagues, with an audience who can react to it. The basic story is that people have relied on long-term returns beginning in either 1926 or 1900, which much of that emanates from work that I've co-authored. But there is recent research which takes us back to before 1900. And so looking no longer at the 21st and 20th century, but looking at the 19th century, we can see the extent to which shares beat or failed to beat government bonds. That's been my focus, and that's what I was speaking about.
Yeah. And what's the kind of general finding there? Is it kind of equities? Are people kind of putting too much kind of weight on equities in your perspective? What's the kind of message from there?
I wouldn't say that people in their portfolios are putting too much weight on equities. What I would say is that the expectations of how equities will perform are very coloured by the published histories, which largely deal with the last complete century. And the century before that, for which we now have both American and British data, is one where US equities did not have the same edge as they had in the 20th century. And so if you were using history as a guide to the future, which is a good idea, the apparent premium of common stocks, shares, compared to government bonds, has been overstated. So people should be expecting relatively less from equities. But it's not an anti-equity stance.
Yes.
I still think equity investing is very important.
Yeah, and how does that play in? Obviously, there's been a lot of talk about kind of 60-40 portfolios over the past kind of few years. How, from your perspective, does that kind of feed into the debate around whether that kind of portfolio construction model is past or is sort of overdone now? What's your?
Well, the extent to which we have a view about the future is very driven by the history we have of the past. Anyone who would look at just the last few years would say, well, stock market investing is a mug's game, it's been disappointing. Anybody who was looking at the whole of the last complete century would say, it's magic. You're younger than me, so you would be amongst those who are perhaps disappointed. And your parents' generation have had all the winnings. They've had the advantages of that. What I'm saying is that the amount that ought to be set aside, if you are saving as a parent that's in between my age and yours for a family celebration on a big scale, you need to be saving a little bit more and maybe spending a bit less on fancy holidays and fancy clothes.
Certainly a debate in my household. Yeah, that's very interesting. So in terms of kind of messages, maybe kind of the audience here today, kind of investment managers should be kind of giving their clients. What would that be kind of based on this research? Would that change? Do you think the way they should sort of be approaching their key messages to clients?
I had three punchlines. One is that America was exceptional, and we've got a large number of countries that we can look at. America made people who bought the index wealthy, wealthier than in other countries. And so my warning there is that extrapolating from the US experience, and the US is a dominant part of many ETF investor portfolios, that's dangerous. So the first thing is to not rely on spotting which country is going to be the best, and therefore diversifying globally. The second message that I had is that equities may do well, they may also do relatively badly. You don't know. And so diversifying across assets is prudent, and so cross-asset diversification matters, even though the evidence is that globally bonds underperformed equities, I'm not an anti-government bond person. And the third one, and I think this has a big impact for ETF investors, is that costs matter. And investors sometimes choose ETFs because they want to bet on a particular sector and they choose specialized products. But the majority, by sort of value of ETF investors, are going for broad portfolios, and they shouldn't be overpaying.
Yeah, it's a really interesting point, and I think it's a big debate in the passive world, is the rise of passive and also the dominance of US equities in that sort of market. I mean, I wondered if you had a view on terms of the growth of passive and whether it's kind of, you know, getting to a point where potentially it's kind of too big a behemoth, and it skews these sort of results a bit more. I don't know.
Well, there is a big debate, of course, about the growth of passive, because passive investors are free riding on stock prices being more or less right because of active investors. But ETFs are not easy to handle for active investors. So it's possible, and you might wish to back a particular fund manager. But because you can grow and shrink those funds, when it's a highly diversified portfolio, that is fairly straightforward. But if it's a very focused portfolio, then you've got to buy and sell, and that imposes costs on performance. Active funds have more of that. So there is a dilemma in terms of what you've got to do if you are a supplier of non-passive funds to do what's right and what is consistent with your skill set.
Yeah, I wonder, I guess, we're seeing at the moment, but a lot of active managers kind of making their way into sort of the passive side of things. I'm assuming that's a trend that's going to continue as well. I don't know if do you have concerns about the growth of passive and the impact that's having on markets, or is it not really?
I think let me give you a personal response, and that is that to me, low cost is very important. And so cheap to manufacture funds have particular attractions. So where is most of my wealth invested? It's driven by high diversification and low costs. And if I went any further than that, I'd probably be advertising either one of your sponsors beyond my brief, or worse still, talking against your sponsors and in favor of another supplier. So, but I think keeping costs low is important. And for that reason, while there might be concerns about the growth of passive in terms of short-term impacts on the market, I don't think it's important for a long-term investor. If you're a buy and hold investor, if you are an institution, I don't think people should be worried about the growth of passive.
So low cost, diversified, that's the kind of key points you
I think that those are the key things for me.
Good stuff. Brilliant. Well, yeah, Elroy, it's been an absolute pleasure. Thank you for your time, and thank you for coming today.
Well, thank you for your questions.